and we'll join in our friends on Facebook too.
We are now recording.
Okay.
If you would like to go ahead and start, I think we can.
Okay, great. Good evening and welcome. I am so excited you have decided to join us this evening. My name is Julie Moore, and I am the proud president of Omega Zeta Omega Chapter of Alpha Kappa Alpha Sorority Incorporated. I would like to take this opportunity to thank each of you for joining us as we host the second of our 3-day webinar series, Managing Your Finances During COVID-19. Before we move into the presentation, I would like to quickly share a little about our international organization. Alpha Kappa Alpha Sorority Incorporated was founded on the campus of Howard University in Washington, D.C. in 1908. We are extremely proud of our 300,000 members serving in over 1,000 chapters worldwide, led by our international president, Dr. Glenda Glover. For more information about our sorority, please visit our website at www.aka1908.com. We, the members of Omega Zeta Omega Chapter, have been serving Bucks County, Pennsylvania since 2015 when we chartered. For additional information about our chapter, please visit www.akaozo.org for additional information. Our international program, Exemplifying Excellence Through Sustainable Service, includes 5 program targets designed to advance the mission of Alpha Kappa Alpha Sorority Incorporated and underscore our commitment to sustainable service. And we are extremely proud to partner with Courtney Richardson, the Ivy investor, for this.
So, of course, there's always a disclaimer. Anytime that we talk about investing overall, we are going to talk about, there may be some stocks that we talk about just kind of in passing for information purposes. But, this webinar is for educational purposes only. The webinar does not constitute an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or other product or service by the Ivy Investor LLC, Alpha Kappa Alpha Sorority Incorporated, or Omega Zeta Omega Chapter of Alpha Kappa Alpha Sorority Incorporated, or any other third party, regardless whether such security, product, or service is referenced in the webinar. Furthermore, nothing in this webinar is intended to provide tax, legal, or investment advice, and nothing in this class should be construed as a recommendation to buy, sell, or hold any investment strategy or security, or engage in any investment strategy or transaction. The IB Investor LLC, Alpha Kappa Alpha Sorority Incorporated, or Omega Zeta Omega Chapter of Alpha Kappa Alpha Sorority Incorporated does not represent that the securities, products, or services discussed in this class or webinar are suitable for any particular investor. You are solely responsible for determining whether any investment strategy, security, or related transaction is appropriate for you based on your personal investment objectives, financial circumstances, and risk tolerance. You should consult your business advisor, attorney, or a tax and accounting advisor regarding your specific business, legal, or tax situation. So let's see. So tonight's agenda, we're going to cover what COVID has done to the market, how COVID has affected your retirement, and what you can do about it. So just if you could you give me some questions that you have regarding today's topic so I am able to really discuss some of the things that are important to you? Because one of the biggest things that we want to make sure we're doing is providing that value. So we definitely want to provide value. So answer any questions that you may have about the stock market or retirement. Please let me know in the comments so we can address those for you. Okay, I see some questions. Okay. Oh, that's a great question. The biggest question is this a good time to start? And then what stocks people should be looking at now that the market is down and if they can afford to invest? Is it wise to invest in oil? These are really good questions. Should you contribute to your retirement or wait till the market heals? Great questions. What's the best way to begin investing and what stocks are best? Really, really good question. So I'm really glad to hear that. So I thought we were going to be able to stream on Facebook, but it seems that for some reason it's not kicking over. But we will have a bill that what we're going to do is I am going to record this, and it's actually recording right now. So what we'll do is we'll put it on YouTube so you can watch it later if you want to share with others. So I wanted to share you this picture because this is the picture that I see when I think of the stock market. Like, what do you guys see here? I see a mess. And that's what I think about when I think about the stock market and what's been going on over the last couple of months. Do you guys feel that way too? Do you ladies feel that way? Do you feel like, hey, it's really been a lot going on and it's a little overwhelming? What do you think? Do you think it's been a lot going on and it's kind of messy? Okay. A lot of people are confused. Okay. Awesome. Awesome. These are pretty fair assessments. So here's the thing. I wanted to give you a picture of the Dow Jones and I wanted to show you on a chart, and you're probably going, Courtney, we are newbies. What do you have this thing up for us? We don't understand. But I give this to you to show you that it was all good. I don't know if you guys listen to hip hop, but it's like there's a song that says it was all good about a week ago. Well, it wasn't a week ago, it was multiple weeks ago, but it was all good in February. February 12th was the highest the stock market has ever been in history. So for it to fall the way that it did, it fell fast and it fell furious. So for that to happen, it's really stressful for a lot of people. But I wanted to give you this picture so when we start talking, you're like, oh, I remember that picture. It's going to come up again. So the thing is that let me go back. So we talked about bear market territory. Has anybody heard that they're saying, oh, we're in a bear market? Has anybody heard that? That's been something that, a lot of people have had a conversation. They're like, oh, it's a bear market. It's a lot of different things. And I like to really share what a bear market is, because bear market, as much as it seems like people are just making up terms, is a real live stock market term. So a bear market is this: when the market falls by 20% or more over a 2-month period, it's considered a bear market. It's kind of like a short period of time that the market drops like that. And that's exactly what happened. So like I said, on February 12th, 2020, the stock market was the highest it's ever been. And then boom, the market falls, and it falls by 20%. And it kind of didn't fall automatically 20% in one day. And we'll kind of talk about how that couldn't have happened. It didn't fall 20% in one day, but it fell over time. So in about a month, it kind of erased everything, all of the gains that it had. So when we're looking at the market or talking about the market, we're talking about the Dow Jones, and it's technically called the Dow Jones Industrial Average. And you're probably going, well, what's the Dow Jones Industrial Average? The Dow Jones Industrial Average is a indicator of the market. And let's see, get you a slide about Dow Jones. So the Dow Jones Industrial Average is, or also called the Dow 30. A lot of people don't call it that, but it's an index that tracks 30 U.S. large publicly held companies. So some of the companies that are included, I don't have them listed here, but Caterpillar, Disney, I have listed, Apple, Home Depot, 3M, Boeing, what else? American Express. So there's a lot of big names that we know, like things that we have in our wallet, have in our houses. Those companies are included in the Dow Jones. And the reason being is that they're considered an indicator of the health of the U.S. economy. So it's like a real-time indicator of what the world thinks about the U.S. economy. And honestly, the Dow Jones is the most watched indicator in the world. So we have the Dow Jones. So if the Dow Jones falls 20% over a small period of time, a 2-month period or so, we're going to call that a bear market. Same thing with the S&P 500. Now the S&P 500, if you kind of realize, is that you have 30 stocks that are indicative or an indicator of the U.S. economy, and then you have the S&P, which is 500 stocks. They're the 500 largest stocks that are traded in the United States, but they're still an indicator of the economy, but not as powerful or persuasive as the Dow Jones. And then you have the NASDAQ composite. It's all the stocks that are traded on the NASDAQ, like all 3,000 of them. They kind of just push them together and push it out. So those are kind of like our three major indicators, but our Dow is what we lead with. So a bear market is caused by uncertainty, which causes fear and selling. So basically, think about a bear. Bear pushes things down. It's if you're going to run from, you're running from a bear, they move kind of slow, but also they're kind of pushing things down. Think about how heavy a bear moves and how, sometimes it moves kind of quick, but it's pushing things down. Think about a bear like that. The most notable bear market was September 2008 to March 2009. So here's the thing. I was working as a stockbroker with Merrill Lynch in September 2008 when the market crashed. September 29, 2008 is when the market crashed. And we kind of knew it was coming. And someone actually made a comment. They said, the market was due for correction. And that's true. I mean, completely the case. The market was really rolling. It was the longest bull market, which we'll talk about in a second, in history. So we were always looking for kind of what's going on. And if you guys remember, there was a lot of uneasiness during the end of 2019 with tariffs. So there was a lot of uneasiness. So the market kind of started to do kind of like a wiggle wobble. Has anybody played Jenga? And if you play Jenga, as you get higher in like moving the little Jenga pieces, what ends up happening is it becomes a lot less stable. And because it becomes a lot less stable, anything can kind of tip it over. So, and that's basically what happened with the market. And one of the things that increased the market participation or the market kind of movement up was the Tax Cut and Jobs Act of 2017. So they allowed, what ends up happening is that the corporate rate went down from 35% to about 20%. And you're probably like, oh, 15%, that's not a lot. But think of it this way, if it's 15% of $1 million, that's a lot of money. So companies were able to buy back some of their shares, which push up their stock prices. So it was just a lot of different things going on at once. And so again, the market was pretty much due for a correction, and that's what happens. But the most notable bear market that we remember was September 2008, which was caused by the housing crisis, and it ended March 2009. So we'll talk about what that means generally, but a lot of people are kind of looking for this thing, this blip we have in the market to end quickly, and it really may not be. But most recent bear market began in March 2020, and you'll learn in a couple of minutes that we are technically out of bear market territory, but does that really mean that we're in the clear? And I don't think so. So let's move forward. So the cause of the 2020 bear market. So we have coronavirus fears. So there are a couple of different layers. I mean, you first have a business supply chain issue. So there's a lot of tech companies that put together their parts in China. So Chinese factories are not operational. The Chinese are actually not being consumers. So they're not producing and they're not consuming. And they're the second largest economy in the world. What do you think is going to happen? What do you think people are going to do? They're going to start to get fearful because now they're saying, well, will these iPhones be made? What's going on? First, and then the second thing is that people are, is the Chinese, are the Chinese going to be buying things if they're in the house? And pretty much no, they're not going to be interacting like they were on a different level. So that's a big thing. But then, so that's a change in consumer behavior. And then that also moved into the United States. So we have a couple of different things. We have a business issue on one side. We have a consumer issue that affects the business. And now we have kind of like a snowball. So that's what kind of started the whole party. So like I said, so that's where we are. So like I said, we had a bull market going on. So the bull market is a market where the stock prices are going up because investors are buying. So they're really excited. So, buying increases prices, selling decreases prices. So are we on the same page with that? Buying increases prices, selling decreases prices. So the most recent bull market started in March 2009. And like I said, it was the longest bull market in history. And it peaked February 12, 2020. It ended March 2020. It might have made another move up, but we're not really sure. And I want to show you something. So remember how I said, is this the end? Are we okay? We had a bottom already. Now we're kind of starting to uptick up. Does that mean that we're done? So investors are thinking, like the average investor is thinking, hey, we had this drop. The drop happened. We're on our way back up. But here's the thing. Because we haven't gotten through the coronavirus pandemic, we're still kind of hanging out. We're still social distancing. Half of the country is still shut down. Analysts think that kind of we're waiting for the other shoe to drop. And what does that mean? We don't know when this is over. We don't know the full depth and breadth of what's going to happen overall with the economy. And a bear market is usually an indicator of what? What do you guys think a bear market is an indicator of? Since that people are selling, they're fearful, they're uncertain. What do you think is going to happen next? Or what do you think could happen next? A recession. Everybody's saying it, a recession, or a depression. So, and the reason why we share this is that, again, we're starting to see what? Bankruptcies, a lot of retails. So here's the thing. We've been asking ourselves, when are we going back to normal? But here's my question. I'm going to ask this right now, and I just want you guys to think about it. Is what we're going back to is normal? Is it going to be normal again, or are we going to have a new normal? So again, we have Macy's looking for bankruptcy or filing for bankruptcy. We have Neiman Marcus filing for bankruptcy. Lord & Taylor. Lord & Taylor is actually one of my favorite stores. Absolutely love Lord & Taylor. I love what they have, but they've been struggling for a while. So I'm not surprised that something like this, would kind of push them over. But Neiman Marcus, I was kind of surprised about. But again, King of Prussia, I live in Philadelphia. So outside Philadelphia, we have King of Prussia, which is the largest mall on the East Coast. And it might be the largest mall in the nation. I'm not sure yet, because they did add like a little section in the middle. But I share that to say, is King of Prussia still going to be like the place, or is it going to change? So again, as we start looking about what we're looking to invest in, how we should be investing, that is something that we're going to look at in a little bit more detail. Okay, so let's talk about the CARES Act. So the CARES Act again, if you joined yesterday, we kind of defined what the CARES Act was. So it's the Coronavirus Aid, Relief, and Economic Security Act. So there's kind of been like a second iteration in terms of funding that was signed, I believe, yesterday by the Senate. Not really sure. I think the House should either have signed it today, I didn't check, or they should be signing tomorrow, and it should be kind of getting pushed through. But this particular iteration of the CARES Act became law March 27, 2020, and it was over $2 trillion stimulus package. But it changed a lot of debt reporting, credit reporting, but it also changed retirement provisions. So we're going to talk about that. So retirement in the CARES Act. So here's the thing, and I've always kind of wondered about this, is that no one really talks about the retirement accounts that we get when we start work. I remember when I first started my first couple of jobs, I was handed like a packet. They handed me this packet and they were like, oh, Courtney, here's your packet. Here's your health. Here's your dental. Here's your 401k. Have a great day. And no one really told me about what a 401k was, how it worked. I kind of knew generally how it worked, but not really. Like I knew that if I put money in my 401k, then that money wouldn't be taxed. But that's pretty much all I knew about a 401k. Did you guys feel the same way when you kind of started a job or starting a new job and you got this 401k? Did you feel like, yeah, I know what I'm talking about. Yeah, I feel comfortable investing in this, or I feel comfortable, I know what I'm doing. Did you guys feel like you felt comfortable when you first handed the packet, or did you feel like, what is this? Yes, a lot of people said they felt overwhelmed. And so that's the interesting thing. So when these changes, so I guess to say like your baseline is, okay, I don't really know what I'm getting, what I'm doing, how this thing works. And then on top of that, now they're making changes to how this thing works. You're like, well, wait a second. This doesn't make that much sense. So I would like to kind of give you guys an overview of retirement and how it affects the CARES Act, and then we'll get into the stock market. So here's the rule. So I'm going to give you the rule. The rule is that if your plan offered you a loan, so some retirement accounts that are with your employer offer loans. And with a loan, you would basically take half of your vested balance or $50,000, whichever is greater, and you could take a loan off of that. You could take a loan which is considered a general purpose loan, and that's for 5 years. You know, if you want to paint the side of your house fluorescent pink with your $50,000, you could, or you have what's considered a residential loan, which was basically for the purchase of a primary residence. And companies had the ability to give you 30 years to actually, 30 years to pay it back. Or most places usually gave you about 10 years to pay it back. So you had a general purpose loan for 5 years, $50,000 at the most, or half of your invested balance, whichever one was greater. And then you had your general purpose loan, same thing, $50,000 or half of your invested balance, but it just depended on the time. So now they said, listen, we're really trying to help people kind of protect themselves if something were to happen. So they're saying, we're going to allow you to take a loan up to your entire vested balance or $100,000, whichever one is greater. So if I have an account that's $70,000, I can get a loan off of my 401k for $70,000. And normally it would have to be for $35,000. So you see how the changes are happening. But here's the thing, that your company doesn't have to offer it to you. You know, it's available. Like so I share this with people is that in the IRS tax code, there's a lot of things that they allow with 401k accounts or retirement accounts that are covered under 401a. That's the section of the retirement code. The IRS tax code. But your company doesn't have to offer it. But that being said, you have the loan, so you have the ability of taking a loan. So also, if you take a withdrawal from your 401k or any other retirement account and you're under the age of 59 and a half, you're subject to a 10% penalty. And so they're saying, you know what? You're not going to be subject to a 10% penalty anymore if you take it and you're affected by the coronavirus. Like you lost your job, your spouse has lost your job, or your dependent, has been adversely affected by coronavirus. So it's a really broad kind of sweep. They're like, listen, if you were affected by it, you were affected, your spouse or your dependent, you can actually, enact these provisions, these special provisions of the CARES Act. And then also you have 3 years to pay it back. A withdrawal. Withdrawals normally you don't have, withdrawals normally you can't pay them back, but you actually have 3 years to pay it back, and your repayments don't count towards your annual contribution limits. So they're trying to really help people, but the problem is, and this is what I've noticed with the retirement provisions, a lot of people don't understand how this works to begin with. So it's kind of like, I don't get the two-step, but now we're doing a cha-cha, but I didn't have the two-step right. So of course I'm going to mess up on the cha-cha. So I wanted to just share these kind of rules and regulations and just show you how it's a little bit different. And then also, I actually had someone ask today about RMDs, or what we consider required minimum distributions. So a couple of things. They've kind of worked together. So the Tax Cut and Jobs Act, I think it was one of the most recent legislations. They said, so let me back up. Required minimum distribution had to happen once you hit the age of 70 and a half. You had to take it. So that's the first thing. And then recently there was a bill that pushed it back to 72. Okay, because people are living longer, so you want your money to grow longer. So let me back up. Let me explain what a required minimum distribution is. Okay, so you have your 401k or whatever retirement account, your IRA, whatever. That money has never been taxed before, unless it's a Roth, but we're not getting into that. Just think about, this is the money that's been deferred out of your paycheck that you never pay tax on. So the IRS says, listen, and let me back up. Deferrals out of your paycheck are one of the biggest expenditures that kind of tax revenue losses that the United States faces. So a lot of people are like, oh, the government's not really getting a benefit. They're not really losing money there, but they are. It's actually one of the biggest losses of revenue that the government actually has on a yearly basis. So you're deferring your money to be taxed at a later time. And the government says, listen, you deferred this money for whatever time period, so we weren't taxing you on it. But the buck stops here, guys. When you hit 70 and a half, you're going to have to take a required minimum distribution. So some of this money, it's based on a table. It's going to have to come out, and it's going to have to be taxed. And that's at 70 and a half. So then the rules changed, and they earlier last year, and they said, okay, no. We'll give you guys until 72 because you're living longer. So we don't want to force a required minimum distribution when you actually may need that money to grow a little bit longer. So then here, this is the change that they did again. And they said the required minimum distributions are waived for 2020. Okay, so now if I'm 72, I don't have to take my required minimum distribution. No one does. So those are the changes that the CARES Act have changed to retirement. So there, again, it's kind of like you're giving me the cha-cha, but I don't even really have a two-step down. But I wanted to share them with you because some of this may come up in your kind of travels as you navigate your retirement. And I just wanted you guys to be very clear about what that was. Any questions so far? We haven't gotten into the fun stuff yet, so sorry. Okay, so the required minimum distribution depends on your balances in all your tax deferred accounts. So it's actually set up on a table. So it really just depends. So you have to sit down and have a conversation with your tax advisor to figure out what your required minimum distribution is. Now, also, your IRA account and then also your 401k, if you still have one, will calculate it for you. But sometimes you want to make sure, and that's why I tell people, when you start kind of moving around, make sure you're kind of taking your money with you because it becomes very cumbersome if you have 5 401ks sitting out there and then you turn 70 and a half and you have to take an RMD from each one of them. So instead, you just kind of roll everything in one pot and then you have a calculation based on that one pot. So let's see. So there's a lot of questions about, one of the questions that I see is that, I don't know whether to do a 401k, a traditional 401k or a Roth. So we'll talk about that in a second. I think it's a great question, but we'll talk about that in a second. Okay, so contributions. So I wanted to kind of talk about how much money can you contribute to all of these retirement plans. So every year it changes. In October, I don't know if you ever follow me on social media, I'm getting excited in October. I'm like, ooh, in October, they're telling us how much we can put away for the next year. I get really excited. It's kind of like almost like Christmas to me, but not quite, but it's almost there. So for 2020, the most you can contribute if you're under the age of 50 is $19,500. If you're over the age of 50, you get an additional $6,500, and it's called a catch-up provision. So they're saying, hey, you're closer to retirement, so we're going to allow you to put an additional $6,500 if you're over 50. That's in your 401k. The 457, 403B, they also have additional provisions that you may be able to enact. So I definitely tell people if you have a 457, which is, and let me back up. If you have a 457 or if you have a 403B, definitely talk to your HR department or the person or the company that's carrying your retirement account, because they may be able to share with you some additional provisions, the additional ways to get more money in. So 401k is for a profit company. So Walmart has a 401k. 457, the city of Philadelphia has a 457. It's for municipalities, counties, and states. 403Bs, usually nonprofits, teachers tend to have a 403B. And then the TSP, which is my favorite account, that is the Thrift Savings Plan, and that's the federal government's version of the 401k. So then you have your IRAs. So there's basically 3 types of accounts that exist in the retirement world. So you have your individual retirement arrangements or accounts. So you have a Roth IRA and a traditional. So if you're under the age of 50, you can contribute $6,000. If you're over the age of 50, you can contribute additional $1,000. So basically $7,000 can be put into a Roth or traditional. And then you have your small business accounts. So you have what's considered, it's a SEP IRA or a simplified employee pension. You can contribute let me back up. If you're an entrepreneur, a lot of entrepreneurs leave this money on the table. They end up getting beat in the head with taxes. And they're like, oh, what could I have done to reduce my tax burden? Entrepreneurs, your small business retirement accounts. That's a way that you can reduce your tax burden and also save for retirement. It's kind of, it works out pretty well. You save for retirement on one hand, and you're also saving from taxes. So I really encourage, if you have a business, if you're an entrepreneur, kind of doing a dualpreneur, doing a full-time and a job, like your business on the side, I really encourage people to really look into these small business accounts. So you have a simplified employee pension, which you can contribute up to 25% of your salary, up to $57,000. You have a simple IRA, which you can contribute up to $13,500, or if you're over the age of 50, additional $3,000 for $16,500. And then a solo 401k has the same requirements of an employer account, which is $19,500, or an additional $6,500 if you're over 50 for catch up. So I share that with you to say, a lot of people have questions about a Roth IRA or a Roth or a traditional, like which one you should do. It depends. It really depends on a lot of different things. I tend to say the more money that you make, I would prefer for you to sit down with the more money you make, you should really sit down and talk to your tax advisor. Because what we tend to do when I work with clients is that we kind of make sure that they're getting the biggest tax benefit that they can, but they're also able to save on a Roth source, which is tax-free. So think of it this way. I like to share about how like the Roth works and how the traditional IRA works, or the traditional 401k works. So the first thing is that, say you make $100,000, because it makes life easy. Make $100,000 and you contribute $15,000 to your 401k, your traditional 401k. So basically that means that you're only getting taxed by the IRS or the federal government on $85,000 of your salary. The other 15 went into your 401k, and it'll be taxed sometime in the future. Okay. So for example, if you have a Roth source, just in your 401k, just put it in perspective. So $100,000, you contribute $15,000 to your Roth 401k, 457, 403b, or TSP. If you do any of those things, you contribute that money. Then, so $100,000, you contribute 15, you still get taxed on that $100,000, but the money goes into what we consider your Roth source or your Roth account. So you're going, well, Courtney, on one hand, I've got a tax benefit from contributing to my traditional 401k, but now I'm not getting a tax benefit. So why would I even contribute to a Roth? Well, on the back end, your Roth comes out as long as the account's been open for 5 years and you've reached the age of 59 and a half, the money comes out tax-free. So if you put in $15,000 and say it grows to $50,000 in the Roth, guess what? It's going to be tax-free. But if you do the same thing in your traditional source, the money grows to $50,000, you're going to pay taxes on that $50,000. Now you can take it out $1,000 at a time, or you can take out the entire lump sum, but that money will be taxed. So that's the difference. So, but I do say to people that if the more money that you actually make, the more beneficial contributing money before taxes, because it helps reduce what we consider your annual adjusted gross income, or the money that you're actually, the income that the government is actually going to tax you on. So those are the things that I want people to sit down and have the conversation with their tax advisor to say, hey, what makes the most sense for my tax situation? Because everybody's different. Think about your tax situation like a thumbprint. That's your tax situation. So you want to make sure that everything is kind of tailored to you. So let's move on. So the question that a lot of people ask me, especially now, because there was a really good question in the comments that said, hey, should I stop contributing to my retirement account, based on what's going on until the market heals? That's a really good question. But here's the thing. Continue to contribute if you can, because again, you're going to be able, over the long term, you're actually able to build up your retirement. So you don't want to stop if you don't have to. Now, there's lots of times if you've been laid off, if someone in your household's been laid off, and you have some kind of, overwhelming need to not contribute, then don't. And don't feel bad about it. But if you can contribute, continue to do so. Now, if you feel uneasy about the market, you're like, Courtney, ooh, what's going on in this market gives me, a lot of angst. I do suggest that you may want to consider the new money coming in, the money coming in from your paycheck, that you have that going to cash for a couple of months until the market levels out. That's up to you. And you may want to talk to a financial advisor about doing that also, but sometimes that helps. But you have to remember to put it back in the market. But also a lot of people are like, oh, I should sell out my current holdings. I lost so much money, I'm going to stop the bleeding. But if you did that, let's say when the market kind of fell apart in March, the market has rebounded significantly and you actually lost a lot of the gains, the potential gains. So I tell people, listen, don't try to time the market unless you're a trader. Do not try to time the market. Just kind of sit there, hold your hands, kind of sit on your hands and let the market do what it does. And then also, like we talked about all the ways to withdraw money under the CARES Act, but I really encourage you not to withdraw money if you don't need it. Like if you need it, by all means. But if you don't need it and you're just saying, oh, this is a way for me to get some extra money, pause. Think twice about doing that because you're really think about it this way, you're robbing your future self, okay? So I wanted to talk about the 7 streams of income because a lot of people have a lot of questions about this because they hear this idea. They're like, oh, the average millionaire has 7 streams of income. And I'm like, I mean, yeah, but that's not kind of quite how they got it. So let's see. I do want to just answer some of these questions before I go into 7 streams. So, okay, so let's see. So I'm not really sure, Elizabeth, what your question is. So we'll just hold that for a second. So a couple of people said they had a Roth TSP. And then someone should say, should you contribute more money if your company stopped matching because of COVID? That's a great question. Sister Blair, what I do suggest that you do is that you continue to contribute what you were contributing. If you want to contribute, if you can afford to contribute more, sure. But one of the biggest things is that I want people to really increase their savings. So, I mean, although you have the ability to get money out if you need it, but don't do that if you can avoid it. But I would pretty much keep everything the same, continue to contribute. And if you want to, put more money aside, do that in what we consider a taxable savings account, like your bank savings account, just so you have the money available. So Katrina asked a question about interchaining the 401k and the Roth 401k. So traditional, when we're talking about our traditional 401k, we're talking about a tax account that's not going to be taxed until it comes out. So $100,000, I make $100,000 in a year. I contribute $15,000. The only portion of that $100,000 is going to be taxed by the government. So it'll be $85,000. The other 15 is going to be put in an account that will be taxed at a later time. And basically what it allows you to do is have tax deferred gains, which over time kind of compounds. Someone also asked if I recommend keeping part of my money in a 401k and put some money in a cash value life policy to tax diversify. No, I really don't. I've been in estate planning for a very long time, and I've noticed that a lot of people like to put money in the cash value life insurance policy. There's other ways that you can do that to actually do it, to kind of put yourself in a better position tax-wise that does not include putting in a life insurance policy. So, okay. So Elizabeth asked a question: can you take a retirement loan from a company you no longer work with? No. One of the requirements from a loan perspective is that you have to have the withdrawals come out of your paycheck on a regular basis. Now, if you have your own business, you may be able to set up a loan provision through a solo or I-401k, but I definitely would talk to your tax advisor if that's something you're looking to do. So to get into the 7 streams of income, let's see, I think I have some other questions, guys. Okay, I'm just taking a look at a couple of, okay. So a lot of people were saying, and I was just taking a look at the question and answers. Some of the things that people are saying, hey, should I hold off on putting money into an account because of what the market is doing? So think about it this way. You have an account and then you kind of pour things into it. So think about it. I shouldn't say account. I should say you have a basket. So your basket is your Roth. You should always put money into your Roth if you can. But what you do with it once you get there depends on what you feel comfortable with. And we'll talk about kind of places to consider to look at in in the stock market or places like that. We'll talk about that in a second, but always still contribute to the account. If you're concerned about what the market is doing, then you might want to put it in what we consider a cash account until you feel a little bit more comfortable, you feel a little bit more educated. But I definitely can tell you that you really need to consider still contributing, because I don't want your fear to rob your future self of a nest egg because you were fearful of what's going on. Still contribute, maybe put it in cash, but still contribute. Okay, so let's briefly talk about the 7 streams of income. You have earned income, which is money that you make, kind of what we say, exchanging dollars for hours. So my 9 to 5 is my earned income. I have interest income, and a lot of people are saying, I don't only have one stream of income. And I'm like, well, you probably have, so a lot of people, you probably have multiple streams of income and don't even realize it. So you have your earned income, you have your interest income. Interest income comes from a bank. So even that 1 cent that you get every year or every other year, that's going to be your interest income. Royalty income is a little bit harder. When I worked in oil and gas, we did oil and gas royalties, and oil and gas royalties are usually a 1/8 royalty. But that's basically someone has a house or they have some kind of property and there's oil under it. And so the oil company will pay you to actually mine your oil. And so you get a 1/8 royalty. It belongs to you. We're taking some of it, but we're going to give you a 1/8 royalty because you're not drilling on your property. Also, if you have a book deal, so not if you kind of self-publish your own book, but if you have it with a Random House or another book publisher, they give you upfront, and then every single book that they sell, they give you a royalty. And then you have rental income. So, rental income is relatively easy, I think. So if you have, you receive rent about $1,000, but you have expenses every month about $500, your income from your rental is going to be about $500. And then you have your profit or your business income. If you have a business, you make widgets. Widgets, for some reason, if you guys ever were in business or economics in college, they always liked widgets, or accounting too. Widgets were really big in accounting. But if you make widgets, your widgets cost you, I don't know, you sell your widgets for $1,000, but they cost you $500 to make. So your profit or your business income is $500. And then finally, we have the income that comes from the stock market. You have dividend income and you have income from capital gains. So we're going to talk about that in a second. And before I even get to the next slide, I just want to double check some of these. Okay, so the question, this is a really good question. I have a Roth and a 401k. Should I max out the 401k before I contribute to the Roth? It depends. So I definitely would talk to your tax advisor, because sometimes a lot of people that I've noticed that are in the position to max out their Roth, they start getting to the point where they have what's considered a phase out. So, but also a lot of 401ks have a Roth source. So you actually can contribute more to your Roth 401k than you can contribute to your Roth IRA. So just keep that in mind. So regarding the loan from a 401k, you could take money out of a former employee to take advantage of the new CARES Act provision. No, your loan provision is only good if you have, if you are currently working with an employer that offers it out of a 401k. Now, if you need to get money out of an account, and like, again, I really advise against this, you have the ability to do a withdrawal, and you have the ability, and you also can take 3 years to pay the money back to the account, or you have 3 tax years to actually pay taxes on that money that was taken out. So you have a couple of different options, but again, definitely talk to your tax advisors about that. Let's see, and just making sure that I'm not missing anything. So there's a lot of different funds in the TSP. So there's a question about what funds I suggest using for a TSP. A TSP, again, is the federal government's version of a 401k. There's about, I think there's 4 funds. There's a G fund, the I fund, I think the S fund, and there's I feel like I'm missing another fund. But it really depends. Your allocation depends on your age. So that's something that you may want to sit down and figure out, based on your age. And sometimes the target date funds are pretty much the easiest thing to do, saying, hey, I'm going to retire in 2040, and you put it in the 2040 fund. So a lot of people, and then someone else asked, do I recommend investing in tangible assets like gold, gold or silver, since the dollar is going down? So here's the thing. I really express to people is that, gold and silver is a store of value. So that's a great point that you brought up. But you may not want to invest in gold and silver if you think the dollar, we're not really sure what the dollar is doing. So just, again, if you're building wealth, I tell you pretty much to stay out of stores of value. If you're older, if you're kind of retired, you may want to look at a gold or silver, which is kind of, and what I mean by store of value, so let me define those terms. Store of value is basically something that maintains its value or maintains its worth, as opposed to the dollar, which does fluctuate a little bit against other currencies. So basically, it's kind of saying like an ounce of gold is like $1, and it's always going to be, $1 or whatever the case may be. So just that's what I mean by store of value. Let's see. So someone asked in terms of interest income, is it advisable to get involved in peer-to-peer lending if you have extra money? If that's something you want to do, I would kind of caution and kind of think about it. And we'll talk about what are the good things about investing. Is about one of the things, we'll talk about what that is in a second, but peer-to-peer lending, if a lot of people are adversely affected by COVID, their ability to pay their debts may be reduced greatly. And so do you really want to put yourself in a position of going that way if you don't know what's going to happen kind of in the next couple of months in terms of people's income to be able to pay you back? Someone asked, is it better to invest in mutual funds than the stock market directly? My suggestion is, if you are interested in investing in, if you're interested in investing in what we consider a pooled investment, which is a mutual fund or ETF, mutual funds, the difference between mutual funds and stock are like, let me back up. So you have stock, you have your mutual fund, and then you have an ETF. It's basically like a stock and a mutual fund had a baby. So a stock is traded on the stock market from the hours of 9:30 to 4. And a mutual fund is always assessed at the end of the trading day. But an ETF, so a stock is one company and a mutual fund is multiple companies. So when you have when you have a ETF or an exchange traded fund, you have a bunch of companies that are traded on the stock market, and they're traded from 9:30 to 4, Monday through Friday, excluding holidays. Okay. So let's go. So we're going to talk about dividend income and capital gains. So dividend income, distribution of earnings to shareholders of stocks, mutual funds, or exchange traded funds, and they can be taken in cash or reinvested. So basically a dividend is a company sharing its profits and earnings with you as a shareholder. So in February, I received about 41 cents per share of for dividends for owning Starbucks. If you know anything, if you had one of my classes, you know that I actually had a stop loss on Starbucks when the market kind of tanked, and I forgot that it was on, so I ended up selling Starbucks. Now I sold it at a gain, but Starbucks kind of popped right back up right after it. That's why I tell people, do not time the market unless you're a trader. And I wasn't thinking about it because I usually have stop losses. A stop loss is a protective measure to say, hey, if this stock falls down to this price, I want you to sell it. It's kind of automatic. But I thought I took all of them off. I thought they all transferred off, but they didn't. So boom, that's what happened. So that's also another thing to kind of pay attention to your accounts, because even I've been doing this for so long, I completely forgot. And I was kind of salty about selling Starbucks. So also income from capital gains. So like I said, I accidentally sold Starbucks. I have a thing for Starbucks, absolutely positively love them. But unfortunately, I don't really do Starbucks anymore because of all the sugar. But I purchased Starbucks years ago at about five shares, about $78. It split, but pretty much I was able to sell at a gain of 47%. I was up a lot more, but again, like I said, when it hit that bottom and immediately sold, I probably would have recovered just fine. So again, be careful when you put these protective measures on the account. So investing in the stock market requires a couple of things. It requires good sense and it requires patience. I'm going to say that again. It requires good sense and it requires patience. A lot of people, you're moving from being a consumer to an investor. So people ask me, what should I invest in? And I'm like, things that like, and trust. That's what you should invest in. So I share that with people to say, so know, like, and trust. What your kids bother you about, and what's up and coming. So I suggest people, look at cannabis, they look at 5G, they look at blockchain. So those are the things that I normally suggest. So let's talk about what you know, like, and trust, and what your kids bother you about. So what I know, what I like, what I trust, um, is going to be, because like I said, I talked about Starbucks. I talked about Target, really like Target. I have a Peloton. So I absolutely love my Peloton. I'm on it every single day. They recently became publicly traded. They recently had what's considered an IPO. They IPO'd, I believe, last September. So again, at some point I decided, you know what, I'm on this Peloton all the time. I absolutely love it. I'm going to invest in it because I really believe in the company and what they're doing. But then also, what your kids bother you about? I can remember back in I shouldn't say elementary school, but in high school, all I wore were Nikes, and I had a Motorola pager. Please, I don't judge me. I had a Motorola pager, and I also had, I had, what else did I have? Motorola pager. I always wear Nikes. I had Nintendo. There's so many different things that I personally had, that I like to share with people. And so again, what are your kids bothering you about? What could be the next thing that's up and coming? And then finally, like cannabis, 5G, and blockchain. So I tell my students, I do teach cannabis, and I was telling my students a while ago, I said, hey, one of the things that, they bug you about Disney. Deborah said, my kids bug me about Disney. That's something that you may want to look into. I'm not telling you to go out and buy it, but definitely go research, is this a company that I should be buying? If I want to buy, if I'm going to be a consumer of Disney on this major level, then maybe I should be a consumer I should be an investor in the company. So a lot of people said, so here's the question, I have Apple everything. Apple, it's like really kind of interesting about how much I have. I have, the Apple phone. I have the Apple Watch. I'm on an Apple right now. So again, one of the things that I think is important for me to personally invest in is Apple, because I use it so much. So someone asked, what's cannabis, 5G, and blockchain? So cannabis is investing in, marijuana. So in the United States, marijuana is still illegal, but 33 states have legalized a medical marijuana program. 11 have legalized a recreational marijuana program. And one of the things that I tell my students in my cannabis class, one of the big things that I tell people is that history doesn't repeat itself, it rhymes. There was if anybody remember history class, history was one of my favorite subjects, but history class, we talked about prohibition. And one of the things that I learned is that the states were kind of like, the federal government said, hey, we have a constitutional amendment and we're going to ban sales of alcohol. And that happened in 1919 to be effective in 1920. So we're like, okay, fine. And then the states were kind of on board. They passed the Volstead Act, and the states were on board. And then the states were like, yo, this is expensive. This is time consuming. And we lost a major revenue source. We're not doing this anymore. So over time, we talk about the roaring 20s. Over time, they just kind of stopped helping the federal government. And then at some point, the depression hit, and governments were like, hello, we need more money. We can't tax people on what they don't have. We're not getting wages. So what are we supposed to do? So again, that's kind of when they legalized. They said, listen, states, do what you want, whatever you want to do. If you guys want to have alcohol sold, you can. If you don't, that's fine too. This is completely up to you guys. So that was kind of what happened with alcohol. And we think same thing when we hit a recession may happen with cannabis. So there's a lot of legislation that's kind of not gotten that far, but there was one, the MORE Act last year that went outside of, went outside of committee. So it's kind of getting a little bit of steam. And like I said, 33 states at least have a medicinal marijuana program. So that's something that people may want to look into. In terms of 5G is the next kind of like cell phones, the next version of cell phones, or cell phone technology. But there's a lot of things that are available. And I actually came across it in my regular everyday life. But I was like, oh, this is interesting. And then when I started looking into it, it's like, it's definitely happening, but it's definitely going to kind of open up a lot of different portals in terms of what's available, kind of in terms of technology. So I said, okay, well, let me look into that. Then I ended up listening to, the FCC and kind of what they've been doing. And I'm like, wow, that's really fascinating. I have a whole class on 5G because it's something that's going on. And then blockchain, blockchain, we hear about cryptocurrency, but blockchain is actually what enables it. But I think blockchain, especially because we're going virtual, is that it's really going to be able to kind of catapult us into a virtual existence. So those are the things that I wanted to explain. So a lot of people, let's see, I'm just taking a look. So people ask like how much they should spend or start investing. So you can start investing with as little as $100. I think that's a pretty good place to start. But a lot of people will say, well, I'm going to invest my $100 in Amazon, which is trading at, I don't know, $1,800 a share. So you're only going to get a fraction of a share. But if you were looking at something like, I'm trying to think offhand, if you're looking at something like maybe Verizon or Sprint or T-Mobile or something like that, I'm just saying, as an example, you can get a lot more bang for your buck. So I do consider that you kind of, start looking at places that you know, like, and trust, but then also kind of look at that list there and say, okay, out of all of these companies that I know, like, and trust, this company is the cheapest. So let's see. I'm just trying to take a look. So just remember that when you have capital gains, so if I have a stock and I have 10 shares of stock and that one stock goes up $1, then I've gotten $10. So so it just depends on how many shares you have and how valuable your company is to the market. So does money you gain out from stocks just sit there until you pull it out? Yes. So you have what's considered realized capital gains and unrealized capital gains. When you have realized capital gains, it actually means that you sold whatever asset it was actually that increased in price or increased in value. That's a realized capital gain. An unrealized capital gain is kind of like I have an account and my account's worth $3,000 or whatever I have in it, and I haven't sold anything. It's just kind of going up or going down. That's an unrealized capital gain. So I'm just taking a look. So Sharon made a really good point, which I love talking about cannabis. I talk about this in my class, is that she said that she's followed cannabis for a while and it should be doing really well, but there's a little bit of funny business going on in cannabis. And, so she feels that a lot of big investors have collaborated to push the share price up. There actually has been quite a bit, she actually said fraud, and there has been some fraud in some of the larger Canadian companies. One of the companies has had basically enriched enriched the board of directors, basically kind of gave a windfall to the board of directors at the expense of investors. So that's a really, really big deal. So no, there's some funny business going on in the cannabis space. So I do tell people, when you're looking to get into these things that are up and coming, that you educate yourself, because there's a lot of information out there. And every so often you'll find some funny business going on. So let's see, I'm just taking a look. So, so there's a couple different things. If you're looking to invest in a company, we'll talk about this in a second. So let me pull up, as a new investor, there's a really good question. How many investors should you make starting out? As many as you can actually follow as a company. I don't want you looking at your account every single day. That's not going to do anything for you, but following the news. And when I say following the news, not every single day, but kind of say like, every so often something will pop up in the news about a company. And I'm like, okay, what's going on over there? There's a couple of classes. Let me just back up. I teach classes. I've been teaching classes for about 6 years. I have a class on Investing 101 or Stocks 101. And then I have a class on 5G investing. I also have a class on investing in cannabis. So I've been doing that for the last couple of weeks. Again, when we're looking at how many shares you should buy of a particular stock, well, it's kind of like, think about going to the supermarket. You're saying, when you go to the supermarket, you go and you're saying, I have $100 to spend. So when you have $100 to spend, then you're starting to look for things that kind of fit your budget. So if you have $100 to spend, are you going to spend it on and you have to, you have $100 to spend, and you have like a small dinner party at your house after, outside opens up. You're like, okay, I have $100. I can spend $80 on caviar and $5 on crackers, and I can get everybody else apple juice. Or do you want to spend $100 to get some chicken, to get some vegetables, do a whole big spread? You're probably going to look, if you're going to try to have a dinner party, to do a whole big spread. So think of it that way. So you want to get the biggest bang for your buck of quality. You're not going to just say, I'm going to buy a whole bunch of Fritos and just, let everybody be great. And I'm going to have some money to take away from the supermarket. You don't want to do it quite that way, but you want to say like, hey, what is the best way that I can go? I have $100 that I'm okay with parting with for the next 5 years or so or more. And I don't feel bad if I actually lose all of my $100. So that's kind of the way I want you to think about it. You know, I have this money to set aside. I don't need it anytime soon. But then also, if I lose this money, I'm not upset. Now, granted, when you lose money, you should be upset, but it's not something that like, hey, if I lose this money, I won't be able to pay my rent. Does that make sense? So let's see. I'm just going to look more at the comments. So if someone asked a really good question, if you sell but you reinvest, you still have to pay capital gains. Capital gains depends on the account that you're selling and you're buying and selling in. If it's a retirement account, you only pay taxes when you pull money out. But if it is a regular taxable account, yeah, you're going to have to pay taxes on the capital gain that you made, even if you reinvest in something else. So Katrina asked a really good question. Aurora's having some problems. So I'm going to deal with Aurora first. So Aurora the symbol is ACB. Aurora is a cannabis company that's out of Canada. They've had a couple of different issues, but that actually was not the company I was talking about. And their share price has actually dropped below $1 a share. You're probably going, okay, what difference does it make? Well, when you're traded on the New York Stock Exchange, you have a requirement as a company to keep your share price above $1. And if not, they're going to delist you. And if you get delisted, that's pretty much like certain death for your company. So what they're doing is they're doing a reverse stock split, I believe May 12th, to basically kind of roll their shares into. So think of it this way. If you had me in class the other day, I just terribly messed this up, but a reverse stock split is basically going to consolidate more of the shares. So if they're doing a 12-for-1, basically think of it this way. They're doing a 12-for-1. So if I have 144 shares today, in May, when they do the reverse stock split, I'll have 12 shares. So, so Christina also asked a really good question. She says, a price to share of an indicator of a company's market value. Yes. So market value is determined by the price per share. So that's what you see when you look up a company's stock price. That's what that is. And then also the number of shares outstanding. So that's something that you usually have to dig for. But the market cap is usually available on most things. It will tell you like Apple is $200 a share plus, and then it will say market cap on the side. And usually right now it should be about 1.2 trillion because based on the number of shares outstanding, that's what the market cap is. So how do you find out when stocks split? Well, it's usually an announcement. If you own the stock, they'll send you something in the mail because they're required by SEC guidelines, but it really just depends. Sometimes you'll just find out in the mail. So I want to get to this point because we're kind of running short on time, is that people are asking, where should you invest? When people are getting started, I really suggest getting started in Robinhood. I think it's just a really easy account to work through. If you have kids, Robinhood is not going to work for you because when you have kids, you want kids to be on the account. The biggest thing is that the biggest thing is with custodial accounts is that when you have kids, they have to be on a custodial account. A custodial account is for minors that are under the age of 18 because minors can't hold money in their own name. So you have Stockpile allows custodial accounts, but Robinhood does not. And then traditional brokerage accounts allow also custodial accounts. So they're either what's considered an UGMA or an UPMA account. That's what custodial accounts are called. And then you also have and you could also have a IRA for a child. If a child, and especially if they have like a summer job or whatever, they can actually open their own. It's considered a custodial IRA. You can do that for your kids. So if they have a babysitting job, if they're a camp counselor or whatever, that can get them started on a really positive track for them to have money in their account that they've earned. So remember, it's their earned income. So if they earn $500 in the summer, they can put up to $500 into the Roth. But they can't put anything more than what they earned into the Roth or any of the retirement accounts. So, but that's just a way to get started. But if you personally have a retirement account, I usually suggest that you do what's considered a traditional brokerage account, which is E-Trade, Merrill Lynch, Schwab, and Fidelity. So those are your options when you have a retirement account. So overall, I would like to thank everybody for joining us. I really appreciate it. We have had interesting technical difficulties, and I will take a look at some of the questions that I may have missed. Please let me know if you have any questions so that I can answer them. So I'm going to look at the Q&A. Okay. Oh, I did miss a really good, I'm sorry, I missed this whole slide that I wanted to talk about. So we think that we're going into a recession. That is the general thought that we have going on. And defensive stocks are usually are what we consider businesses that provide consistent earnings regardless of the economy. So basically, you need toilet paper whether the economy is doing well or not doing well. You need healthcare, and if the economy is not doing well or not, you still get sick. And then utilities, I mean, well, your lights may be cut off, but more or less you're going to make sure your lights are on and kind of get rid of something that's a little bit more of a luxury. And then telecommunications. Telecommunications used to be considered what we consider a cyclical stock, or a stock that goes along with the economy. Economy's doing well, they do well. Economy's not doing well, then they do poorly. But now they're becoming like, Apple, we're looking at our iPhones, they're more pretty much like more of a thing with our lives. They're more interwoven. And because they're more interwoven, here's the amazing thing is that they're going to be more of a staple. So they're going to be more considered defensive. So that's what I really wanted to share. Just that industries that typically do well in a recession. That's something that you may want to look at. And then you have companies that typically don't do well in a recession. Financials, banks, they usually don't do well because what happens when a recession happens? People start foreclosures, share sales, all those things. Then also consumer discretionary, what we consider like cars are considered consumer discretionary. If you're laid off or you're having some problems like people are having now, are you running out to go buy a new car? Unless you have to. And if you do, you're usually going to try to buy a cheaper car. You're not going to go out and buy a Benz. So those are the things that I like people to consider, when you're looking to invest during a recession. But even still, consider to invest in the things that like, and trust, that you use, that your kids bother you about, all of those things. So I'm going to just take a look at the Q&A a little bit more. Let's see. Okay, so how do you actually invest? Do you need a broker? No, with Robinhood and a lot of these companies online, the ones that I mentioned, you can do all of that online. It's relatively easy. You just go on. Now, I want to remind people that you're going to have to provide some information that you may not want to provide over the internet. Now, granted, they're secure sites. Make sure that has the HTTPS, but you're going to have to provide them your date of birth. You're going to have to provide also, you're going to have to provide your social security number. There's a lot of information they're going to have to ask of you, partially because of tax reporting, because they have a requirement to report to the IRS what's going on in these accounts in terms of buys and sells and rollovers and things like that. So I think I was able to answer blockchain kind of in a way that was helpful. Someone asked my views on purchasing a home during this time. I mean, if you can, then, and that's what you're looking to do, you've been saving for it, I wouldn't not purchase a home right now. But I can say that, I'm personally working on a loan myself, and it's taking way longer than it should because the courts in Philadelphia County are shut down, and they have to, when they're ever doing a mortgage or they're doing some type of loan, like a big loan, they have to do what's considered a title search. The title search goes through the courts, and what's not going on right now? The courts are not open. So I understand that. So I'm taking a look at some of these. So someone asked a really great question. What happens to their 401k when they leave the company? So when you leave the company, it depends on how much you have in your 401k. So if you have under $1,000, they'll do what's considered a force out. So a force out is basically if you don't respond, I think it's about six months or a year. If you don't kind of do something about the money, what they'll do is they'll send you a check and take out 20% for withholding. And then, you'll get what's considered a 1099-R at tax time that you have to claim that 20%. So that's the first thing. If you have between $1,000 and $5,000, they can keep you in the plan, or they can roll you into like a holder IRA. And if you have over $5,000, they can't get you out of the plan. You just pretty much stay there. But I do suggest, especially, and we'll talk about this tomorrow, that if you can consolidate the accounts that you have, then that you do so. Just really, really consolidate what you have, because otherwise it gets a little messy. And I think it gets really hard for people to manage all those things that are going on. If you pass away, like, where all the stuff is, or you may not, but your family is going to have a little bit of a problem finding it. So I definitely share that with you. Now, if you, in terms of getting the money out, you can roll it over on your own into your own account. If you have your own business, you may want to roll it over into a business account. There's a lot of different options you have. So someone asked, if they have an IRA, how much should they put into it? I would definitely have a conversation with your tax advisor, look at your budget. I do want to say generally investing is like excellence. It's a habit. So commit to how much money that you want to be able to contribute, even if it's $25 a month, because you want to get yourself into the habit. So I think I answered. Someone was asking, is it okay to decrease the percentage that you contribute to your 401k until COVID gets better? Well, it depends. Do you need the money because you're like running low on funds or you're laid off or something like that? Or you're just saying, hey, I would like a little bit more in my savings account. I do suggest that people have about 3 to 6 months in savings. I know that the financial industry has gotten a little bit away from that, but now we're kind of going, we said, a $2,000 at the minimum, but we probably really meant 3 to 6 months now that we're looking at COVID. So it just depends on your personal financial situation. And I do suggest that you kind of sit down and kind of go over like what your needs are to see if you really need to stop contributing or you're just doing it because you just don't feel comfortable with the market.
Hey, Sir Courtney, can we do our poll real quick?
Oh, I'm sure. No problem. So I'm going to launch the poll. So I apologize. So what I have launched, there's a poll that pops up and we just ask that you guys answer the questions. There's about 5 questions in there for you to take a look at. So really appreciate it, especially like where you learned about our event. We would love for you to come back. So let's see. I'm just going to try to make sure that I'm covering all the other questions. Okay. So someone asked, what telehealth stocks are the most viable to invest in? So investing is very personal, and I share that with people all the time. So the companies that I'm going to invest in because I know, like, and trust them or I understand their business may not be the same for you. And one of the things I say about one of my best examples about me and a stock that I was in love with and then I fell out of love with is GE. So I purchased GE right after the stock market crashed in 2009. Really loved the stock, thought it was doing well. I had a really good dividend. That's why I tell people not to chase dividends. So GE was a known dividend company. I believe it was considered what's called a dividend aristocrat, meaning that for the last 25 years, it's increases the dividend every single year or something like that. So GE, at some point I was kind of hearing on the news or I was reading somewhere and they were like, hey, GE, I said, oh, GE is losing money. And I was like, okay, well, that happens. I mean, every company like GE has been around forever. I mean, over 100 years. So yeah, they have ebbs and flows. So I was like, all right, cool. GE's, they're losing money. It's fine. And, I looked into that and then I looked again and I said, and then I looked at their dividend and their dividend hadn't moved. And I said, well, wait a second. If you guys are losing money and your dividend is a distribution of profits and earnings, you should not be having a dividend. So what I saw in them is that I said, oh, wait, you guys are just doing this dividend. So, people continue to invest in you and think you're a good company. But I was like, oh, no, GE, I'm not fooling around with you. But again, I just happened to catch that information. And like I said, I try to keep up with my companies, but because I'm a shareholder, one of the things about being a shareholder is that, the company has a responsibility to me is like increase my shareholder value. If they have profits and earnings that they're not reinvesting, like Amazon does not give dividends because they reinvest their profits. One of the things I'm expecting to get that money back. So there's a couple of different things that I talk about. So I'm like, hey, I want to get my dividend. I want, you guys to increase shareholder value. And I have the ability to get to pick the board of directors. So that's what I have as a shareholder. But again, I still have to kind of pay attention to what's going on in the company. So that's kind of my obligation, my responsibility. And that's why I say know, like, and trust, because you conceptually want to know with the company. There's a couple of questions that I ask, about 4 questions about investing. What does the company do? Like, what do they do? How do they make their money? What is the company's opportunity? Are they going to be around in 10 years? Like, what's up? Is it a company that's kind of like a flash in the pants, like Crocs, or are they a company that has the ability, and sometimes you don't know this until like hindsight is 2020, because if someone said to me, do you think Amazon's going to be the powerhouse that it was when I was ordering books from Amazon in 2003? Absolutely not. So again, it's a question of, is the company able to kind of evolve? And sometimes you just don't know that. But you can probably guess that by looking at the company's management. What is management doing? And then also looking to see how much is the company. Can you afford it? I say, like, my affordability for a company is, can I afford 10 shares of a company? That's what I usually think. And that's how I judge my affordability. So I think that is pretty much all the questions that I see. Did I miss any? So I think that is pretty much it. Does anybody else have any questions? I hope I was, oh wait, there's a lot of questions. um, so great. I really appreciate it. So I think everybody is all done. We have the poll up, and then someone asked about Robinhood. Robinhood, I really do like. Really, really like Robinhood. I think it's easy to learn. I think it gets you really in the vibe of investing. It has a little bit of glitches, a little glitchy recently, but I think overall it's a pretty good app to use. So blockchain, for me to explain blockchain a little bit more in detail, I would suggest that you kind of just like, that you Google it. I hate saying, oh, Google it, but I think it's going to be a longer explanation that I think if you kind of take some time and Google, you should be able to kind of get up to speed and see where the opportunity, if there is one for you. So thank you all for, yes, my classes are open to everyone. Oh my goodness, I'm so sorry. I didn't give you my social media information. See, so what happens is when technology goes wrong, I get upset, and this is what happens. But I hope you all really enjoyed it. I'm really sorry that we weren't able to post to the Facebook. I may actually redo it on Facebook because I'm like really upset that we weren't able to broadcast. But again, thank you so much for joining. You can catch me on Instagram at the Ivy Investor. You can catch me on YouTube at the Ivy Investor, and also on Facebook at the Ivy Investor. So really, thank you so much for joining us. You can definitely grab my classes. I put information on my classes. My classes are also on Teachable. So I'm going to put the Teachable link available. And again, if you guys have any questions, please feel free to reach out to me on social media also. So we're just having, those days. So thank you so much. Please stay safe. I'm really just considering that, I'm just glad that we're able to sit down and have these conversations, and, hopefully we're able to get out of this safely, with some more education that we kind of go out into the world. So thank you so much. Have a great evening.